Evening, everybody. It's Peter Schiff. It's Monday, January 27th, 2010. Well, we had a snowstorm here last night in New England, also affected New York, New Jersey. As a result, not a lot of volume on the New York Stock Exchange today. In fact, it was the lowest full trading day since New Year's Eve of last year, 2009. The stock market, though, was relatively quiet. The big news that came out over the weekend was in China. China once again raised interest rates. They increased rates by a quarter of a point, 25 basis points. But, interest rates, deposit rates in China are still considerably below the official inflation rate as measured by their consumer price indexes. So I do not believe this rate increase will do anything to restrain inflation. In fact, it's more likely to make it worse. And I've mentioned that dynamic before on this blog. See, what happens is China raises rates, but the U.S. does not. And so now Chinese deposits are more attractive relative to U.S. dollar deposits because there's a higher rate of interest. So more money flows into China to earn that higher rate of interest. The Chinese government is now forced to increase money supply even faster to buy up dollars to prevent the exchange rate of the RMB from rising. And money supply grows more rapidly, and you have more inflation and more pressure on consumer prices. It's kind of like a dog chasing its tail. It's never going to catch it. Ultimately, what China is going to have to do is allow more significant appreciation of its currency so that it no longer has to expand its money supply. If it does that in conjunction with raising interest rates, then it will make some headway on reversing the inflationary forces. But of course, when they do that, that actually puts even more downward pressure on the dollar and upward pressure on the RMB, because not only will the RMB have higher rates, but it will also offer greater appreciation for anybody selling dollars and buying RMB. And so rather, when we do that, we will get a sharp rise in the RMB. And what that will do is that will cut off the inflationary pressures in China, but ignite an inflationary wildfire in the United States, because a sharp drop in the dollar against the RMB will send prices in the U.S. higher, and it will also send interest rates higher. Now, not today. Interest rates actually were off a bit today. And bonds started off on the defensive, but then we had a better than expected Treasury auction, and as a result, we got a bid in the Treasury market, and rates declined. Commodity prices initially sold off, as did the price of gold, immediately following the Chinese rate hike. But commodities regained their strength. The CRB was only down slightly on the day, but beneath the surface, many commodities hit new contract highs. In particular, soybeans hit a new contract high. Soybeans are almost $14 a bushel right now. Copper hit a new record high. Live cattle hit a contract high. Corn hit a contract high. And this is on a day where China raised rates. The dollar, which initially rallied a little bit last night after the announcement of the Chinese rate hike, the dollar sold off, and the dollar index dropped about a quarter of a point on the day. Oil initially declined on the news, then rallied late last night to make a new 52-week high, close to $92 a barrel. Then we sold off a bit. Oil managed to close negative on the day in U.S. trading. But, I was listening on CNBC, and once again, I saw a discussion where the economists were trying to downplay the inflationary implications of these surging commodity prices, and they said, well, companies can't pass on higher commodity prices the way they can higher wages, and since wages aren't rising, companies are just going to eat the higher commodity prices, and so we don't have to worry about inflation. I mean, that makes no sense at all. I mean, why would they eat these prices? What's the difference if your wages are going up or other costs are going up? You're still going to try to recoup those higher costs by passing them on in the form of higher prices. It doesn't matter whether it's wages or whether it's raw material prices. Either way, your profits are getting squeezed, and you're going to look to raise prices. Now, so in a recession, if consumers are not buying, initially businesses might not raise prices, but ultimately they're not going to replenish their inventories. They're going to order fewer products in the future to have smaller inventories so that they can charge higher prices. So yes, in the very short run, it's possible that companies will eat higher prices, but they're not going to eat it in perpetuity. They will quickly realize that the market has changed, that their customers cannot afford to buy as much merchandise, so they will have leaner inventories, and they will charge higher prices. In fact, one person was trying to say, well, you know, the wage component is a much bigger part of the overall cost structure than commodities. Well, maybe now. Well, but the problem is, as commodity prices get higher and higher, they become a bigger and bigger component of the overall cost structure. Obviously, if commodity prices keep rising, there could be a point in time where those import costs are actually a bigger component determining retail prices than our wages. And of course, this whole notion that we don't have to worry about inflation as long as we have high unemployment is nonsense. I mean, you think that's really true? That you can print all the money you want as long as there's unemployment and there's no adverse consequences? That's just not true. In fact, history shows the exact opposite. If you look at countries that have high levels or low levels of unemployment, they tend to have low levels of inflation. And countries that have high levels of unemployment have high levels of inflation. That's the correlation. In the short run, it might not necessarily happen on a month-to-month basis, but over the long run, that's the positive correlation. The fact that so many people are whistling past this graveyard because they're so convinced that they don't have to worry about anything as long as there's all this unemployment, that's nonsense. And if you think about it this way, oil prices now are, what, $91 a barrel. I think they're going to be over $100 a barrel very soon, probably in January of next year. And I think oil will stay above $100 a barrel for 2011, that the average price of oil will be north of $100 a barrel. Who knows? We might even challenge the $150 a barrel high that we put in early 2008. But I think all these commodities are going to resume their uptrends. Now, the last time oil was even as high as it is right now was in 2000. Late 2007, early 2008, when everybody believed that the global economy was firing on all cylinders, right? This is before the bursting of the real estate bubble, before the collapse of the investment banks, when the Dow was around 14,000, when everybody was saying that the global economy had never been in better shape, you had synchronized global growth, and we had commodity prices around these levels. Now, we have basically Europe, the United States, and Japan, the largest economies, with very, very mild growth. We have the problem in the Eurozone. People worry about a collapse over there. High unemployment in the United States. People worrying about a double dip. No growth in Japan. Yet we have commodity prices at the same levels that we had when everything was great. We had all this economic growth. So what's changed? What's going on? We're having inflation. It's inflation that's creating rising prices. Everybody is assuming that the reason that stock prices are rising and that commodity prices are rising is because quantitative easing is going to create economic growth. Well, there's no evidence that that's actually happening. But it does make sense that if you create a lot of money, you create a lot of inflation. And so prices rise. And that's making sense. In fact, bonds are falling. Today they rose, but in general, bond prices are falling. Falling bond prices are very consistent with inflation. That's what's going on. But the problem is going to be that when the economies apparently were growing and when people had jobs in 2007, $100 barrel oil was far more affordable than it is today, where so many people are unemployed. And you don't have all the economic growth, but we have the commodity prices. And my feeling is that $100 barrel oil in 2011 is going to have a far more detrimental impact on consumers and on the economy than what $100 a barrel oil did in 2007. When home equity was still there, when the economy was still theoretically expanding. Anyway, I also wanted to read. I saw some quotes. I'm just fumbling around the computer to find them, from Senator Tom Coburn, who's senator from Oklahoma. Listen to what this guy said on Fox News yesterday. Now, this is a sitting United States senator. This isn't gloom and doom Peter Schiff making these points. Here's what he says, quote, The problems that face our country today, the last 30 years, we have lived off the future, and the bill is coming due. Out of control debt could cause 18% unemployment and a massive contraction in the economy that would destroy the middle class. The people that will be harmed the most will be the poorest of the poor, because we'll print money to try to debase our currency and get out of it, and what you'll see is hyperinflation. If we didn't take some pain now, we're going to experience apocalyptic pain, and it's going to be out of control. The idea should be that we control it now. The U.S. only has about 3 or 4 years to get its fiscal house in order, or it could find itself facing austerity measures like those seen in Greece, Ireland, Spain, and Portugal, and earlier in Japan. The history of republics is that they average 200 years of life, and that they all fail in human history over fiscal matters. They rot from within before they collapse or are attacked. Now, this is a sitting U.S. senator. The one area where I might disagree is I don't know that we have 3 to 4 years to get our act together. I think we're going to face the music far sooner than that. Anyway, that's it for today. Thanks, everybody, and I'll blog again hopefully before the end of the new year.